What is the biggest risk you face as an investor? The biggest risk you face is that you lose money you can't get back. It's gone forever. This happens because you're a human being. You're not some rational Superman. You think with your crocodile brain. You try to avoid risk and you chase returns. We know that people do this because we have studies that show it. For the last 20 years, the stock market made 10%, the bond market made 6%. Investors made 5% in stocks and 1% in bonds. We know why this happens. Daniel Kahneman won the Nobel Prize for figuring it out. Basically, when faced with too much information, we use our gut to decide what to do. We're not only irrational, we're almost perfectly, predictably irrational. Instead of using our gut, Dr. Kahneman suggests we step back from the decision and look at the choices in a logical fashion. An investment advisor's job is to help you avoid making this mistake. For example, trying to avoid risk is not a good choice because it cannot be done. When you buy a guarantee, the guarantee is really that you will do worse than you would by following a similar strategy on your own. When you buy insurance, you're simply transferring a portion of the underlying expected return to the insurance company in exchange for not seeing the actual daily fluctuation of the account value. This means you'll lose a lot of money and never get back. The second big problem is that we chase returns. Over the last 10 years, the share of investments into index funds has doubled from 16% to 34%. This happened because U.S. indexes, which are market capitalization weighted, did so well. They did well because they're really price momentum indexes. These indexes are disproportionately full of stocks that did very well. Every year, the best performers are added and the worst performers are subtracted. This is not only ludicrous, it created an opportunity for some of the best managers in the business to get their start, like Seth Klarman in the early 80s with Baupost. Anyway, the market moves in cycles. While I don't know when we will have another major downturn, I do know that we will have one. As you can see, the market had a couple of tough periods over the last 20 years. Investors in the market could have been down nearly half and taken 5 years to recover only to see their portfolio plummet again. Investors in broad market indexes in 2000 would have lost 38 to 45% in the U.S. or in world stock markets. The largest mutual funds were also down substantially. If investors in fact acted rationally and stayed invested, it would have taken them 5 to 6 years to see a return to 2000 values, only to see the indexes fall again. But investors in fundamentally based strategies fared better. Based on the work of investment experts we trust, we created higher and medium return buckets based on fundamentals. These investment buckets fared much better, making money from 2000 to 2002, as you can see in the green, because there were wide disparities in value. Some things were cheap. In fact, about 1/4 of the stocks in the indexes did well over that period. But 2007 to 2009 was a tougher period. Market indexes and the largest funds, like those in most company 401ks, were down about 55%. Even the fundamentally based strategies, shown in yellow and orange, were down substantially. However, the fundamentally based strategies, even in 2007 to 9, recovered much more quickly. Instead of taking 5 or more years to recover, they were back to even in 1.5 to 3 years or so. We call the combination of the downturn and the length of time it takes to recover an investment ulcer. We feel that an investment approach predicated on fundamentals may reduce the downturn and quicken the recovery period. We use a combination of psychology and statistics to do this. To learn more about our process to helping investors avoid the biggest risk they face, send me an email so that we can start a conversation.